So I want you to imagine walking into a casino.
Okay. Dangerous start.
Right. But you find a table, you sit down, and you quickly realize the rules here are, well, they're completely different from anything you've ever experienced.
Oh, so?
Well, there's no dealer telling you that bets are closed. There is no maximum bet limit posted on the felt or anything.
Whoa, go.
Yeah, in fact, if you run out of chips, the game doesn't even pause. It just keeps going, and it starts pulling directly from your bank account, your savings, literally everything you own.
That sounds terrifying.
Right. It has no beginning, it has no end, and it has absolutely no limits on how much you could potentially win. At first glance, I mean, you might think you've stumbled into the ultimate opportunity, the perfect scenario for infinite wealth.
Yeah, but the irony is that this total lack of structure, this absolute pinnacle of freedom, really is the exact architecture of a psychological trap.
Yeah.
Human beings, we are conditioned to operate within physical and temporal boundaries. When you remove all of those boundaries and replace them with an environment of, like, unlimited potential, we don't thrive. We completely unravel.
And that unraveling is exactly what we are getting into today. Welcome to the deep dive. Today, we are digging into some truly fascinating source notes analyzing Chapter 4 of Mark Douglas's work on trading psychology.
Yeah, it's a great chapter.
It really is. It's titled The Dangerous Illusion of the Big Win. And our mission for this deep dive is to figure out why this concept of unlimited potential in the stock market, the very thing that draws millions of people to their screens every single day, is actually a total psychological nightmare.
Yeah.
We are looking at how to protect yourself from your own neurology when real money is on the line.
Which is so important because understanding that neurology is critical. I mean, your brain is fundamentally miswired for the environment of the financial markets.
Miswired in what way?
Well, it is actively using ancient survival mechanisms to sabotage your modern financial decisions.
Yeah.
It's wild.
Okay, let's unpack this. If we go back to that casino analogy, right? The traditional casino is a highly structured, heavily regulated environment. The house sets the rules.
Right.
The house sets the maximum bets. If you put down $100 on black at the roulette table and it hits red, well, the dealer sweeps away your chips. The game is over.
It's done.
Exactly. The boundary is external. The limit is enforced upon you without you having to, lift a finger or make a secondary decision.
Yeah, and think about how the casino functions as this, external regulatory system for your behavior. You don't have to decide when the hand of blackjack is over.
The cards just tell you.
Exactly. The cards dictate the conclusion. The physical environment literally saves you from yourself.
Yeah.
But in the stock market, those external boundaries simply do not exist.
Right. There's nobody stopping you.
There is no casino boss tapping you on the shoulder saying, hey, you've lost enough. It's time to go home. And because the market lacks these physical and temporal boundaries, the responsibility of setting limits falls entirely on you.
Which is a lot of pressure.
It is. You have to be the player and the pit boss simultaneously. And human psychology is, frankly, almost comically unequipped to handle that dual role.
Because we are essentially asking our brains to do something they find deeply unnatural, which is to voluntarily accept pain and loss when there's this, theoretically unlimited upside staring us right in the face.
Exactly.
Yeah.
The core issue really comes down to risk clarity. If you look at gambling, you know your exact risk before the game even starts. You push your chips forward, you know you can lose those exact chips, and that's it. That is the absolute worst-case scenario.
Right. The math is closed.
Yes, closed math. In trading, you never truly know how far a price will travel. I mean, a stock could go up 1,000%, or it could go all the way to zero, dragging you down into margin calls along the way. The math is open-ended.
And that open-endedness seems to be the breeding ground for what the source material calls the illusion of fulfillment.
Oh, yeah. That's a huge trap.
Because the market could, theoretically, go anywhere, it becomes incredibly easy to convince yourself that every single trade you make has the potential to fulfill your wildest dreams.
Yep.
The unlimited nature of the market just triggers these deep-seated fantasies of total financial independence. You stop seeing a minor fluctuation in a stock price and you start seeing your retirement home.
Or a new car.
Right. Or your kid's college tuition, or just the day you can finally walk into your boss's office and quit.
What's fascinating here is how quickly the brain conflates a mathematical possibility with a guaranteed outcome.
Oh, wow. Yeah.
Because the brain releases dopamine not just when we achieve a reward, but when we anticipate one.
So the fantasy itself feels rewarding.
Exactly. When you project your need for a new house onto some volatile tech stock, your brain starts chemically rewarding you for the fantasy before the trade is even played out. You are no longer analyzing the actual force and consistency of the market participants.
Yeah.
You're just analyzing your own desires.
But let me push back on that for a second. Isn't optimism like a baseline requirement for investing?
Sure.
I mean, if I don't believe an asset is going to appreciate in value, I wouldn't allocate capital to it in the first place.
Yeah.
You have to believe in the upside. So why is hoping for a big win inherently dangerous? It just sounds like you're describing a confident investor.
That's a great question. But there is a vital distinction between calculated objective analysis and the psychological hazard Douglas is describing here. Objective optimism is forming a hypothesis based on data. Saying, I believe this asset will appreciate because of X, Y, and Z market conditions.
Right. It's grounded in reality.
Exactly. But the illusion of fulfillment is demanding that the market behave a certain way because of your personal needs.
Oh, I see.
Yeah, evaluating a trade based on the fact that your rent is due next week or because you desperately want to be a millionaire by 30, that completely blinds you to present moment risks. You are imposing a narrative onto a neutral environment.
Yeah, you're projecting what you need onto an environment that is completely indifferent to your existence. The market does not know you exist.
It doesn't care.
It doesn't care about your rent or your dreams of buying a boat.
Not at all.
Yeah.
And when you let those deep-seated fantasies attach to a trade, your analytical mind just shuts down. You are no longer observing reality. You are demanding that reality conform to your fantasy.
Right.
And when the market inevitably does something that contradicts that fantasy, your brain actively starts to distort incoming data just to protect the dream.
Which brings us to how our brains filter information to keep that dream alive. Because once the fantasy of the big win takes hold, we don't just passively hope for the best, we get defensive.
Very defensive.
The source material outlines this mechanism called selective exclusion. When you deeply believe a trade is the one that's going to make you rich, you literally only perceive the information that confirms your bias.
Yes.
You watch the ticker, and your brain only registers the ticks that move in your favor. Like a 5-cent jump feels incredibly validated.
At a 20-cent drop?
Completely ignored. It's like putting on a pair of heavy blinders.
And those blinders serve a very specific biological purpose. I mean, the brain is an incredibly efficient machine. But holding two conflicting realities.
Yeah.
The reality that you are, a smart, successful person, and the reality that you are currently losing a significant amount of money that creates severe cognitive dissonance.
It hurts to hold both.
It really does. It is computationally expensive and emotionally taxing for the brain to process that conflict. So to resolve the dissonance, the brain simply deletes the negative data.
Wow.
It refuses to process the threatening information in your peripheral vision to protect you from psychological pain.
So we are actively blocking out reality just to maintain a warm illusion of hope. But, why is the brain treating a red number on a computer screen as a threat that requires this level of defense?
Neurologically, the brain's threat detection system, the amygdala, hasn't evolved to differentiate between a physical threat and a psychological one. Yeah. A predator rustling in the bushes and a plunging stock portfolio trigger the exact same biological alarm system.
That explains so much.
Right. The notes break down this concept of unfulfilled expectations. Psychological pain occurs when there is a massive gap between your beliefs, what your dopamine system has already projected as reality, and what the market is actually doing. And the wider that gap gets, the more intense the pain.
And to avoid that pain, we don't just wear blinders. We start building elaborate mental fortresses. The mental gymnastics we do when a trade goes south are just incredible. We start rapid fire rationalizing.
Oh yeah. The market is just experiencing a temporary macroeconomic pullback.
The institutional algorithms are just trying to shake out the weak retail hands before the real rally.
The company's fundamentals are stronger than ever. The broader market just hasn't realized the value yet.
I'll just average down. I'll buy more at this lower price, and when it bounces back, I'll be even richer.
We've all been there.
We really have. We use any justification possible to avoid admitting that the original assessment was wrong.
But here's the thing. These distortions are just a temporary painkiller. Reality in the financial markets is relentless. You could ignore the gentle warnings, but compounding rationalizations inevitably lead to what Douglas calls a moment of forced awareness.
Forced awareness.
Because you refuse to process the small pains along the way, the eventual break of the illusion comes as a massive, devastating shock. It's not a slow, gentle realization. It's a sudden, violent collapse of the fantasy.
And here's where it gets really interesting and honestly a little terrifying. The notes provide a specific cautionary tale to illustrate the mechanics of this collapse. Let's walk through what the source calls the hope spiral.
Okay, let's do it.
So picture the scenario. You enter a trade, you're feeling confident, you've got that fantasy of financial independence humming in the background, you've mentally already spent the profits.
Naturally.
But then the market starts moving against you, the position starts losing money. Now in a rational, bounded world, you would execute your exit strategy, right?
You just take the small loss.
Exactly. But the market has no limits, and it's not forcing you out. So you stay in, and you stop trading reality, and you start trading your imagination.
You sit there staring at the red numbers on the screen, vividly visualizing them turning green. And this is where the biological freeze response takes over.
Freeze response, like fight or flight.
Exactly. Your brain perceives the loss as a physical threat, but instead of fighting or fleeing, it freezes. Confirmation bias goes into overdrive to soothe the panic. The trader in this hope spiral becomes completely detached from objective market data.
They just check out of reality.
They start frantically scouring the internet, gathering only the news or opinions that support a reversal. They will literally dig into the deepest corners of obscure financial forums to find one anonymous poster who agrees with their failing position.
While entirely ignoring the overwhelming consensus of the tape that the trade is just dead. They are curating a custom reality to avoid the pain of unfulfilled expectations. But, I mean, the market keeps moving, the account balance keeps shrinking, the margin requirements are getting tighter. So the critical question is, if they are completely detached from reality, when do they finally hit the sell button? Like, when did the blinders finally come off?
The grim reality outlined in the text is that the trader only exits when the magnitude of the loss becomes so absolutely overwhelming that the pain of staying in the trade finally exceeds the pain of admitting failure.
Wow. Let that sink in. They don't exit because the market data changed.
No.
They don't exit because a technical support level was broken.
Nope.
They don't exit because their strategy told them to. They exit because they have reached their absolute threshold for psychological agony. They hit rock bottom.
Because they refuse to define a limit at the beginning of the trade, they forced the market to define it for them by pushing them to their breaking point.
Right.
And in an unlimited environment, by the time your psychology reaches that breaking point, the market may have moved against you indefinitely. It could be threatening your entire net worth. You've allowed a single mundane trading decision to escalate into a catastrophic financial event purely because your brain was trying to protect a dopamine fantasy.
It's a tragic irony, really. In trying to avoid the minor discomfort of a small loss, you guarantee the agonizing trauma of a major one.
Exactly.
So if our biology is so hardwired to trap us in this delusion, how do we outsmart our own survival mechanisms? How do you actively prevent the hope spiral if the environment won't do it for you?
The solution is conceptually simple, but psychologically excruciating. Since the market has no limits, you must provide your own before the trade even begins. You have to manufacture the casino environment yourself. You have to be the pit boss who sweeps away the chips.
Predefining the limit. This is the primary action step highlighted in the text. You are forcing a boundary into a boundaryless space.
Practically speaking, I mean, we all know what a stop loss is mechanically, right? It's a predetermined price level where your broker automatically closes out your position.
Right, a failsafe.
But psychologically, a hard stop loss is an entirely different beast. It is a commitment contract with your future panicked self. It is the artificial boundary that the market refuses to provide. When you predefine your risk, you remove the terrifying unlimitedness from the equation. You know exactly what the worst-case scenario is before you ever allocate capital.
You are drawing a line in the sand before your amygdala ever has a chance to hijack your prefrontal cortex.
And that is crucial, because you must trade without fear to see the market objectively. If you are terrified of losing everything, you will inevitably fall back into selective perception. The stop loss is the only tool that allows you to look at the market without those protective blinders, because the existential threat has been quantified and capped.
But human beings are masters of self-sabotage, right?
Oh, absolutely.
Even when we know the rules, even when we understand the psychology, we find ways to undermine our own boundaries. The source highlights two major pitfalls that traders fall into here. The first is the classic unforced error, moving the stop loss.
The worst.
You set your boundary, the market starts creeping toward it, and suddenly you feel that ping of panic. The pain of the realized loss is right around the corner. So what do? You log into your brokerage, you cancel the stop order, or you drag it further down the chart. You tell yourself, oh, it just needs a little more room to breathe. The volatility is just shaking out the weak hands.
And that is the ultimate act of self-deception. In that moment, the pain of the impending small loss feels too real, so you choose the fantasy again.
You retreat.
You voluntarily choose to re-enter the unlimited environment, destroying the only artificial boundary you had. And the second major pitfall the text identifies is trading with scared money.
This is using capital that you actually need for your real life. Rent money, food money, money for your kids' tuition.
If we connect this to the bigger picture, the psychological load of trading with scared money is just devastating to cognitive function. Think about the mental bandwidth required to process complex probabilistic information. Trading with rent money is like trying to solve a complex algebraic equation while someone is holding your head underwater.
That is an intense visual.
But it's true. Your brain completely abandons logic, probability, and objective analysis. It shifts entirely into a panic-driven survival mode.
Your working memory is just completely hijacked by the stakes.
If you are trading with disposable capital, a loss is frustrating. If you are trading with your rent money, a loss is an existential threat to your survival. It massively increases the psychological pressure to fulfill those fantasies we discussed earlier.
Right, because you can't afford to be wrong.
Exactly. When you need the trade to win so you aren't evicted, your brain's selective perception goes into maximum overdrive. You literally cannot afford to see the reality of a losing trade. So you will build the thickest mental defenses possible, you will rationalize, you will deny, and you will lock yourself in the hope spiral until the forced awareness completely destroys your livelihood. Objective analysis is biologically impossible when your survival is on the line. So the text leaves us with a vital reality check. It's a single, piercing question that you must ask yourself during any trade, especially when you feel that anxiety starting to creep in. It's a mechanism to pull you out of the fantasy and back into the present moment.
What is it?
The question is, am I seeing what is happening or am I seeing what I hope will happen?
Oh, that is so good. That is the ultimate test of objectivity. It forces you to audit your own perception. Are you evaluating the actual present moment reality of the market data, or are you just projecting your desires onto a blank canvas? Am I seeing what is happening, or am I seeing what I hope will happen? So what does this all mean? Let's bring all these threads together.
Let's do it.
The market is not a casino. It is an unlimited environment with no beginning, no end, and no enforced boundaries. Because of that unlimited nature, it easily triggers dangerous fantasies of the big win. These fantasies cause our brains to use selective perception, blocking out threatening data, and spiraling into catastrophic losses just to avoid the psychological pain of admitting we were wrong.
And the only way to combat this biological default is to step in and do what the market refuses to do. You have to build your own boundaries, you have to use hard limits, you have to quantify your risk before entry, and you can never ever trade with capital required for your survival.
Right.
By predefining your risk, you cap the fear. And when you cap the fear, you can finally observe the market objectively.
You take the blinders off. You stop relying on the illusion of fulfillment and start operating in the reality of probabilities.
Which brings up a really compelling broader point.
Oh, what's that?
The principles Mark Douglas lays out here for trading psychology, they're not just about the stock market. They are universal principles of human behavior operating in boundless spaces.
Okay, I like where this is going.
Think about it. If the ultimate danger of the market is that it is an unlimited environment that requires us to build our own boundaries to avoid psychological trauma, where else in your life are you suffering? Because you're treating an unlimited environment as if it will eventually set a limit for you.
That is a phenomenal question.
Think about your career ambitions. The corporate ladder has no built-in endpoint. You could always work one more hour, take on one more project, chase one more promotion.
Yeah.
If you don't set a limit, the environment will consume all your time and health. Or consider your scrolling habits.
Oh, don't get me started on scrolling.
Social media feeds are literally infinite. There is no bottom to the page. If you don't decide when to close the app, the algorithm will happily hold your attention until 3 a.m., or even your availability to others. If you never set boundaries with people who constantly demand your energy, they will just keep taking.
Because you're hoping the environment will suddenly provide a boundary. You're sitting at the table, watching your chips disappear, waiting for a pit boss who doesn't exist to tap you on the shoulder and tell you the game is over.
Exactly. Whether it's the financial markets, your smartphone, or your workplace, Engaging with an unlimited environment without predefining your own limits is a recipe for forced awareness. Eventually, the reality of burnout or exhaustion or financial ruin will break through the illusion. The responsibility of the boundary is always yours.
So the next time you find yourself staring at an endless feed, or an overflowing inbox, or a blinking stock ticker, remember that you are in a casino with no rules. You have to be the one to decide when it's time to walk away. Ask yourself what is actually happening versus what you hope will happen, and set your limits before the environment sets them for you.